Back to management accounting. In this video, I will cover the cost of materials and valuation methods. In this video, we are going to cover the cost of materials, under that inventory control and calculation of inventory relevant cost, and EOQ and levels of inventories. Then we are going to learn issuing and valuation of stock of materials under FIFO, LIFO, and weighted average method. Inventory control is a part of inventory management. It's also called stock control. It is the process of ensuring the right amount of supply is available in the organization. Inventory control is also known as the coordination and supervision of inventory supply, storage, management, and distribution. The inventory control techniques include methods for avoiding overselling stockouts and inventory replenishment dates. Let's see what are the objectives of inventory control. Inventory control will ensure the smooth production process. It also prevents overstocking and understocking of materials. It promotes issue of materials and safeguarding the materials from loss of stock by theft and fire. Further, it provides protection of materials from unnecessary wastage of materials and protection of stores against pilferage. Further, it will minimize the storage cost. When it comes to inventory relevant cost, there are two types. First one is the holding cost, the other one is the ordering cost. Let's see what is included in the holding cost. It's include the opportunity cost of investment in stocks, insurance cost, warehouse and storage cost, material handling cost, as well as cost of deterioration and obsolete stocks. When it comes to ordering cost, it includes incremental clerical cost of preparing a purchase order, receiving deliveries, and paying invoices. Economic ordering quantity or EOQ is the optimum ordering quantity. In other words, it is the quantity for which the cost of holding plus the cost of ordering is minimum. It can be calculated by using this formula. Here, D represents the usage of units for 1 year. CO represents the cost of making one order or the ordering cost. CH represents the holding cost per unit of inventory for 1 year. And Q represents the order quantity. Now let's see what are the assumptions of EOQ. The first one is constant demand. Although the EOQ model assumes a constant demand, we know in practice scenario, the demand is vary from day-to-day operations. So if the demand is not known in advance, we should modify the model by inclusion of the safety stock. Constant unit price means we are assuming that the purchase price per unit of material will remain unchanged over the period of time. Constant carrying cost means that we are assuming that the carrying cost is fixed over the period of time. However, we know that this carrying cost may vary substantially as the size of inventory rise. Perhaps it may decrease because of economy scale or shortage efficiencies. Then the constant ordering cost. We know that we are thinking that for order a particular unit or inventory, we have to spend a fixed sum. Prompt delivery means if the delivery is not immediate, what will happen? we have to modify this EOQ model by applying the safety stock. Final one is the independent orders. If multiple orders resulting cost saving by reducing the paperwork and transportation cost, the original EOQ model must be further modified. This modification is complicated. Therefore, it's easy to assume that we are doing the independent orders. Now let's see how to calculate the EOQ based on the values given. So first we are going to use the formula. In this formula we know that the D is the number of units which is ordered in annually, that is 12,500. Then CO is the cost of ordering, that is 20 rupees, and CH is the cost of holding, that is 2 rupees. So ultimately we are getting 500 units as the EOQ. Now based on these values, please calculate the economic order quantity. So you have to assume that the annual demand is 125,000, the purchase price is 100, so annual cost of holding is 10% of that, which is 10 rupees. Then the ordering cost per order is 250. Therefore, the ultimate EOQ will be 2,500 units. The ABC company is producing for which required annual demand of 25,000 units. The ordering cost per order is 1,500 and the holding cost per unit is just 3 rupees. Now let's calculate the EOQ based on these figures. Just see whether you are getting 500,000 units as the EOQ. What are the major types of stock levels? The first one is the reordering level. That is the maximum consumption rate into maximum reorder period. The next one is reorder quantity. That is the maximum usage into maximum lead time. Sometimes for certain calculations we can use the EOQ by replacing the reorder quantity. The next one is the minimum stock level. That is the reorder level minus normal consumption into normal reordering period. Third one is the maximum stock level. That is the reorder level plus reorder quantity minus the minimum consumption into minimum reordering period. The final one is the average stock level. This can be calculated in two ways. That is minimum stock level plus half of the reorder quantity, or in some equations you can see it is the maximum stock level plus minimum stock level, and we are going to divide it by 2 by taking the average. Do you know what are the factors taken into account while deciding the minimum stock level? The first one is the lead time. The time taken in processing the order and executing is known as the lead time. It is essential to maintain some inventory during this period to meet the production requirement. The second one is the rate of consumption. It is the average consumption of material items in the industry. The rate of consumption will be decided on the basis of past experience and production plans. Thirdly, the nature of material. If a material is required only against a special order of the consumer, then the minimum stock will not be required for such materials. Reordering level. When the quantity of materials reaches a certain level, then refresh order is sent to procure a material again The order is sent before the material reach is the minimum stock level. Let's see what are the factors which will decide the maximum stock level of a firm. The first one is the availability of capital for the purchase of materials in the firm. If we have adequate capital, then we can have a larger amount as the maximum stock level. If not, we have to reduce the stock level based on the availability of the capital. This next one is the maximum requirement of material at any point in the time. Thirdly, the availability of space for storing the materials as inventory. If our warehouse is smaller, then we have to decide what is the maximum stock level based on the capacity. If we have a larger capacity, we can have more stocks as the maximum stock level. Then the rate of consumption of the material during lead time. If we are consuming a particular material frequently, the rate of consumption is high. Therefore, we have to keep a larger sum as the maximum stock level. Finally, the cost of maintaining the stores. By storing a larger amount of stock, we incur sometimes more electricity, sometimes more security, more insurance. Then, if the cost is high, we have to make a balance. Therefore, we have to decide what is the cost we can bear up in maintaining the stores. Based on that, we have to decide the maximum stock level. Then, the possibility of fluctuations in the prices of various materials. You know, in frequent years, in Sri Lanka as well as in the world, the price is fluctuating more based on the economic conditions. But if a material have a frequent fluctuations in the price, we have to store more for the better side. Therefore, we have to increase our maximum stock level. If not, what we can do is we can have a smaller amount as the maximum stock level. By storing a larger amount of stock, on the other hand, we can earn economies of scale. So we have to keep a balance in between these factors when deciding upon the maximum stock level. Then, nature of the material. If the material are perishable in nature, then they cannot be stored for long period. Therefore, we have to reduce our maximum stock level. Now, let's see this question. Here, the XY company's annual stock requirement is 250 units. The ordering cost per order is 100 rupees and the holding cost per unit is 15 rupees. In this company, the minimum lead time is 4 weeks and maximum lead time is 6 weeks. The maximum consumption is 75 units and the minimum consumption is 25 units. The normal usage is 50 units per week. So, we have to find out the reorder quantity, reorder level, maximum stock level, minimum stock level, and the average stock level. So, you can use the formula I have given in the previous slide for the calculations. Now, let's calculate the reorder quantity first. To calculate the reorder quantity, we can use the economic order quantity or the EOQ formula. So here, to get the annual demand, what we are going to use is, we are going to use the normal usage. So here in this question, the normal usage is 50 units per week. Since there are 52 weeks per year, we are going to multiply it and we are going to get the annual demand. Then we have to multiply that value with 2 as well as 100, which is the cost of order, and we have to divide it with 15. That is the cost of holding. Then we have to get the square root of the whole thing. So you will get ultimately 186 units as the reorder quantity. Then the next one is we are going to calculate the reorder level. For that, we have to use the maximum usage into maximum lead time. Here, maximum usage is 75 and maximum lead time is 6 weeks. Ultimately, we are getting 450 units as the reorder level. Then let's see how we are going to calculate the maximum level. For that, we have to use the reorder level, and then from that value, we are going to deduct the minimum usage into minimum lead time. Then we are going to add back the reorder quantity. So accordingly, reorder level is 450 units, reorder quantity is 186 units. So we have to get the minimum usage into minimum lead time, which is 25 into 4. Ultimately, you will get the maximum level as 536 units. Now let's see how we are going to calculate the minimum level. For that, we have to take the reorder level and we have to deduct the normal usage into average lead time. So here the reorder level we have already calculated as 450 units. So we have to deduct normal usage of 50 into 5, which is the average lead time. Ultimately, we will get 200 units. Then the average level. So I have taught you two formulas to calculate the average level. So here I have used maximum level plus minimum level, and I'm going to take the average on them, which is 293 units. Now let's see this question. There are two products, which is A and B, and we have given the minimum usage, maximum usage, normal usage, as well as ordering quantity and the delivery period. So we need to calculate the reorder level, minimum stock level, as well as maximum stock level. Let's calculate the reorder level. For that, we have to take the maximum usage into maximum lead time. So let's calculate the reorder level of the product A. So here, the maximum usage is 150 and the maximum lead time is 6. Therefore, we are getting 900 units as the reorder level of product A. Then, reorder level of product Y is 150 into 4. That is 600 units. By using this given formula, we can calculate the minimum level. So in the product A, the reorder level is 900 and we are going to deduct the normal usage of 100 into average lead time of 5. Then we will get 400 units. For product B, the reorder level is 600 and we are going to deduct the normal usage, which is 100 into the average lead time of 3. Then we will get 300 units. By using this formula, we will be able to calculate the maximum level. So when it comes to product A, the maximum level is 1300 units. To calculate that, we have used the reorder level of 900 units. From that, we have deducted the minimum usage into minimum lead time. So that is 15 to 4. Then we have add back the reorder quantity. So let's see what will happen to the maximum level of product B. So in the product B, the reorder level is 600 and from that we are going to deduct the minimum usage into minimum lead time, which is 15 to 2. Then we are going to add back the reorder quantity, which is 1000 units. So ultimately, as the maximum level of product B, we are getting 1500 units. So now let's look at this question. So Kasun Enterprise manufactured a special product called casual, and the following particulars were collected for the current year. So here, rather giving the annual demand, they have given the monthly demand. So it's 1250. Then cost of placing order is 50 rupees and carrying cost per unit is 5% of the ordering cost. So when you are going to do the calculations, so you have to take 5% from this. Then the maximum usage is 1500 units per week and the minimum usage is 400 units per week. So the reorder period also given. So minimum is 4 and it goes to the maximum of 16 weeks. Then you are required to calculate the following. So you have to compute the EOQ, reorder level, maximum level, safety stock, as well as the inventory cycle period. So altogether, you are getting 10 marks. Now just try to find the answers for the above inventory levels. So let's calculate the reorder quantity first. So here you can use the EOQ formula to calculate the reorder quantity. So when you substitute the figures, you may note that it is 774 and 6 decimals. So when you are applying the units, you must know that we can't keep decimal places. So what you are going to do is you have to replace the decimal places and you have to round it off. So rather than using 774.6, you have to use 775 units by rounding it. Then the second one is you have to calculate the reorder level. So you have to take the maximum usage and maximum delivery time to calculate the reorder level. So by substituting the figures, you may get 24,000 units as the reorder level. Now let's calculate the maximum level. To calculate the maximum level, you have to use the reorder level, which we have already calculated. Then you have to deduct the minimum usage into minimum delivery time, and then you have to add back the reorder quantity. So you may get the answer as 23,175. So now what we are going to do is we are going to use these figures and we are going to calculate the safety stock. So safety stock is the reorder level minus average usage into average lead time. So reorder level is 24,000. So average usage is 950 into the average lead time of 10. So the answer is 14,500 units. Now after calculating these stock levels, what we are going to calculate is we are going to calculate the optimum cycle time. So that is the EOQ divided by the annual demand and multiplied with the number of days. Normally here we are going to use the production dates. So it can be 366 or 365 depending on the year. If it's a leap year, we are going to use 366. So ultimately the value is 18.86 days. So here we can't say decimal points for the days. Either we have to keep it in hours or minutes. So rather than keep it decimal points, what I'm going to do is I'm going to replace it with 19 days approximately. According to the general accepted accounting principles, there are three ways of pricing the stocks. First one is FIFO, which is the first in, first out. The second one is LIFO, last in, first out. And the final one is the weighted average. This method is based on the assumption that materials that are purchased first are issued first. As a result, the materials are issued at the oldest cost price in the store ledger account will be shown in the cost of sales, and the material in the stock are valued at the price of the latest purchases. Now let's see what are the advantages of FIFO. Actually, it's easy to understand, and it is a good inventory management system since the oldest units are used first and inventory consists of the latest stock. Actually, it facilitates comparisons. These comparisons can be interfirm as well as intrafirms. Interfirms means firms within the industry. Intrafirms means if it's a consolidated company, then in between firms. Actually, valuation of inventory and cost of finished good is consistent and realistic if we are following the FIFO. As you all aware, according to LKS 2, as well as International Accounting Standard number 2, it says inventory should be valued either using FIFO or weighted average method. Now let's see what are the disadvantages of FIFO. The first one is the cost of production is not linked to the current prices. We know that according to the FIFO method, cost of sales is always the oldest prices. Second one is when the prices are rising, the production cost is understated. But if the stock turnover is high, the inventory will reflect the current prices. The effect of current market price is not revealed in issues when prices are rising. Thirdly, it does not represent the true picture when many lots are purchased at different prices. So the calculation becomes complicated. The pricing of material returns is difficult in FIFO method. At the same time, the high inflation creates problems in replacing used materials. In the LIFO method, the principle adopted is that the materials used in production are from the latest prices. The inventory is priced at the oldest cost. As this method applies the current cost of materials to the cost units, it is also known as the replacement cost method. This is most significant method in matching cost with revenue in the income determination procedure. When it comes to advantages of LIFO, when the transactions are few, it's really useful and simple method to apply. And most of the people are using as a method to avoid taxes. And it is a systematic method. It matches the current cost with current revenue in a better way. Also, it reveals real income in the time of rising prices. Finally, it minimizes unrealized inventory gains and losses. Even though there are many advantages, there are some disadvantages too. The first one is when the rate of material receipts are highly fluctuating, this method becomes complicated. At the same time, when the cost of batches varies greatly, then it's difficult to do the comparisons of interfirm and intrafirms. At the same time, unless the purchases and sales occur in equal quantities, the current cost cannot be easily matched with the current revenue. Further, the companies can use it to report the income at their own will. They can time the purchase to cause high or low cost and manipulate the income. The existing profit sharing and bonuses can be affected by an accounting change. So the employees may not be understand what are the reasons behind this. Lily Manufacturing Limited uses material velvet for their production. The following information was extracted from the books of the company for the month of June 2022. So you can see the date, description, quantity, as well as the prices. So now you are required to assess the value of inventory as at 30th June 2022 based on the FIFO method. So now let's figure out how to apply the FIFO method for the inventory valuation. So first, on June 1st, we have to put the opening balance of 100 units at 20 rupees. So the value would be 2000. Then on 4th of July, we are receiving 300 at 22 by giving the total of 6600. So when you add back the 100 units with these 300 units, altogether we are getting 400 units and the value would be 8600 by adding 2000 and 6600. So the next one is on 8th of June, what we are going to do is we are going to issue 300 units. So here we are going to use the first in, first out. So what we have already in the balance, we have to issue it first. So 100 units at 20, we are going to issue the first opening balance. Then we are going to issue the next thing as the purchases on 4th. So from the 300 units, we are going to issue the balance 200 at 22 rupees. Ultimately, we are getting the value as 6400 by adding this 2000 and 4400. So we are going to issue these 300 units at rupees 6400. So now what is the remaining balance? So we are left with 100 units now at 22 rupees of current price and the value is 2200. So the next one is we are going to purchase on 12th. 12th we are going to purchase 700 at 25 rupees. The value is 17,500. So we have to add back that one to the remaining balance of 100 units. So what we are getting is we are getting 800 units and the value is 2200 plus 17,500, that is 19,700. Then on 18th June, what we are going to do is we are going to issue 200 units. So since we are going to use the now this time we are going to use the same question, but we are going to record the inventories based on the LIFO method. According to the LIFO method, what we are going to do is we are going to issue the last coming stocks to the warehouse first. Likewise, it's go chronologically. So on 1st of June, we have to record the opening balance of 100, which would resulting 2000 rupees. Then on 4th of July, they have purchased 300 at 22 rupees with the total value of 6600. So now we have to add these 300 with 100 units to get the balance of the units. At the same time, to get the total value, we have to add the 2000 and 6600. So the balance as at 4th of June will be 8600. Now on 8th of June, what they have done, they have issued 300 units. So now what is the price? So here you have to remember, since this is the last in first out, we have to go for the latest price, which is 22. So the value would be 6600. So the remaining balance would be the opening stock value. Then on 12th June, they have received 700 at 25 rupees. So the total value is 17,500. So now we have to add the opening inventory value. At the same time, the latest purchase unit. So the total inventory value in units is 800. That is 100 plus 700. Then the value is 2000 plus 17,500. So the total value is 19,500 as at 12th June. So 18th June, what they have done, they have issued 200. So here, since we are going to use the last in first out, we have to refer the current prices, which is 25. So the total value is 5,000. So now we'll see how to create the closing balance. So here, so you can see we still have the opening inventory of 100 at 20 rupees, which is 2000. Then from the 700, we have issued 200 units. So the remaining balance is 500 at 25 rupees. So the value is 12,500. So we are left with 600 units at 14,500 rupees. So on 28th June, they have issued another 400. Still, we have to go for the latest price. Since we have 500 units left with the current prices, we can issue this with the current pricing prices. So the price is 25. The ultimate value is 10,000. Now we are left with 100 units with 20 rupees 2000 plus, since the price 500 we have issued 400 units, we are left with just 100 units at 25 rupees. So the value is 2,500. Altogether we are left with 200 units with 4,500 as at 28th June. Now let's see the same question, how we are going to record the inventory based on the weighted average inventory valuation method. We know that weighted average method is the method which has been emphasized by the LKS 2 to record the inventory valuation. So according to this method, first of all, we have to record the opening inventory. On 1st of June, that is 100 units, the total value is 2000. So on 4th of June, they have received 300 units at 22 rupees. The total value is 6,600. So we are going to add this value to the opening inventory. So we are getting 400 units with the total value of 8,600. Now on 8th June, they are going to issue 300 units. According to the weighted average method, what we are going to do is we are going to take the weighted average price. So to get the weighted average price, we have to divide the total value with the total units, which is 8,600 divided by 400. So the price is for two decimal places is 21 rupees and 50 cents. So the total value is 6,450. So To get the balance, what we are going to do is from the 400 opening balance, we are going to deduct this 300. So the ultimate unit value would be 100. So to get the inventory value, what we are going to do is we are going to deduct 6,450 from 8,600. So the remaining balance on 8 June is 2,150. Now let's move on to the next transaction. In the next transaction on 12th June, they are going to receive 700 units at 25. So the total value is 17,500. So we are going to add this to the opening inventory of 12th, which is 100 with 2,150. So when we add this 750, the unit value would be 800 units and the total is 19,650. Now on 18th June, they are going to issue 200 again. So here also we have to take the weighted average price. To get the weighted average price, we are going to do is we are going to divide 19,650 with the total units of 800. So the value is 24 rupees and 56 cents. Then the total value after multiplying these 200 units with 24 rupees and 56 is 4,912. Then to get the remaining balance, we have to use the same procedure. Since we have already 800 units, we have issued 200 units, the inventory balance is 600. To get the balance of the inventory value in rupees, from the 19,650, we are going to reduce or deduct 4,912. So the value is 14,738. Now let's move on to the final transaction, which is on 28th June. They are going to issue 400 units. Then we are going to take the weighted average price as above. That is from 14,738, we are going to divide by 600. Since we are going to issue the same quantity, the weighted average price results the same. That is 24 rupees and 56 cents. So the issuing value is 9,824. So from the 600 units, we are going to issue 400 units. So the inventory remaining balance is 200 units. Then to get the value, what we are going to do? From 14,738, we are going to deduct 9,824. So the ultimate ending value is 4,940. This is the summary of inventory valuation. Here I am going to compare the FIFO, LIFO and weighted average cost of sales as well as closing stock from the inventory valuation reports. So in FIFO, to get the cost of sales, I am going to add the cost of issue. So here the FIFO cost of sales, by adding all together, it will come as 21,100. So by adding the issue cost of LIFO, the cost of sales figure is 21,600. By adding the cost of issue, the weighted average cost of sales is 21,186. Now let's see the final closing stock figure. In FIFO, it is 5,000. In LIFO, it is 4,500. And in the weighted average cost, it is 4,940. So by going through this figure, you may note that in FIFO, you have the least cost of sale. And in LIFO, you have the highest cost of sale. Then in the weighted average, it is a moderate figure in between the FIFO and LIFO. When there is an increase in price, what will happen? The FIFO issue cost is lesser. Why? Because we are issuing at lowest prices. And in LIFO, the issue cost is high. Why? We are going to issue with the current prices, which is rapidly increasing. Now let's look at the closing stock. In the closing stock, FIFO method recording the highest inventory cost and the LIFO is recording the lowest inventory cost. And the weighted average is range in between the FIFO and LIFO. What is this? What is the reason behind this? In FIFO, since we are going to issue with the lowest price first, the remaining inventory is from the current prices. In the case of rising prices, it means the highest price. In LIFO, we are going to issue the current prices or the current quantities first. Then what will happen? In the balance, we are having the prices with the lowest value. Therefore, the closing stock figure is lesser compared to the FIFO method. The Bees Trading Company has disclosed the following information for the month of August 2022. So you are required to compute the inventory on 31st August and the cost of goods sold for the month of August using FIFO, LIFO and weighted average method. So the table provides you on each day what is the sales, what is the purchases as well as the beginning inventory. Now let's prepare the inventory report based on the FIFO valuation method. Now let's go through the calculation. So here, first of all, we are going to calculate the sales. To get the sales, what we are going to do, we are going to multiply the selling quantity with the selling prices. So we have to multiply 400 with $12, 1000 with 12.50 cents dollars. At the same time, 600 units with 13 and 50 cents dollars. So the ultimate value is 25,400. Now let's see how we are going to calculate the cost of sales. So first we are going to take the opening stock or the beginning inventory. That is 600 into $5. It will give 3,000 for you. Then we are going to take the purchases. So there are only two purchases. That is 1,600 into 6 and 1,000 into $6.50. Then the final one is we have to take the closing stock. So here earlier at the beginning we have 600, then we are going to issue 400. So we are going to deduct that 400. Then we are going to add back 1,600. Then we are going to issue another 1,000. Then we are going to purchase back another 1,000. And finally on August 27th, we are going to issue 600 as sales. So the remaining inventory value is 1,200. So how we are going to price it? Since this is the FIFO method, we should remember the remaining inventory should reflect the current prices. So the latest prices of 1,000 should be taken into account. So that 1,000 is at $6.50. Then the remaining 200 For that, we have to go for the next purchase, that is 1600. From that, we just have to take 200. Then 200 into $6. Altogether, the closing stock value would be 7,700. So ultimately, the cost of sales is 11,400 and the gross profit is 14,000. So let's calculate. It's under LIFO method. So here also, first we have to take the sales. To get the sales, what we are going to do is, we are going to multiply the quantity with the relevant selling price. So the sales value is 25,400. Now next step is calculating the cost of sales. In the cost of sales, first we have to take the opening inventory or the beginning stock. For that, we are going to take 600 into $5, which is 3,000. The next option is we are going to calculate the purchases. The purchases is the purchase quantity into its relevant prices. So here, the value is 16,100. Now, the final step is calculating the closing stock. Earlier also, by adding the opening inventory as well as the purchases and by deducting the sales quantity, we are left with 1,200 units. So now, the key factor is how we are going to value this 1,200. So you know that when you are going to follow the LIFO method, first we are going to issue the latest or the current stock. Then, according to that, in the final sales on 27th. So, this final sales 600 should be made with the current purchase 1000. There, we are going to left with 400. So this balance 400 should be valued at the purchase price of 6.5. Then just go through the next one. In the next one, we are issuing 1000 units on 15th August. So we have to make this 1000 by utilizing the current purchase of 1600. So the value would be, we are having a balance 600 and it should be valued at $6. Then take the other sale. On 10th August, we made 400 units as sales. So it should be made from the beginning balance. So there is balance 200. So this should be valued at $5. So then the ultimate value of 7,200 we will get as the closing stock. So by adding the opening stock, adding the purchase and deducting the closing stock, we are getting 11,900 as the cost of sales. So my dear students, what will be your gross profit? So your gross profit would be 13,500 under LIFO method. So if you have any gray area, how we have calculated the closing stock, how we have calculated the cost of sales. So you can refer this basic inventory valuation table under LIFO method. So get the issuing cost and see whether it's tallying with the cost of sale. Get the final balance and see whether we have arrived the same figure under the previous calculation. So this will add another value to your life, how we can fasten the calculation process rather than going for a lengthy process like this. Now let's see how we are going to do the calculation based on back or the weighted average method. Here also we have to calculate the sales first. Sales, we have to take the selling quantity with its selling price. So the value is 25,400. So in the cost of sales, what we are going to do? The first one is we are going to take the opening inventory. For that, we have to take the beginning inventory into its price. So that is $3,000. Then we have to take the purchases. For that, we have to multiply the purchase quantity with its price. So the value is 16,100. Now it's the time to calculate the closing stock. The closing stock value is, as a quantity, 1,200. So how we are going to calculate it? For that, we have to take the weighted average cost. So this weighted average cost can be taken by following the FIFO method. In the weighted average, we are just thinking that we are going to issue whatever the quantity comes first. But here, the pricing is the crucial part. In the pricing, we are going to take the total value and we are going to divide it among the units and we are going to identify the weighted average cost. So here, we are left with 1,200. So the value of that 1,200 is 7,472. For this one, I have used the old inventory valuation method of preparation of table. So the cost of sales figure here is 11,628. And this will result the ultimate gross profit of 13,772. So in the basic inventory valuation report on the back, I have recorded on the 1st of August the opening balance of 600 unit as 3,000. Then I have recorded the issuing or the sales value of 400 units at 5, that is 2,000. Then I have left the balance of 200 with $5 as 1,000. Then I have recorded the purchase of 1,600 at 6 rupees, 9,600. So I have added the beginning balance of 200 units and the current purchase of 1,600 and arrived with the total unit of 1,800. Then I have put the beginning inventory value at the same time purchase cost. So altogether it is 10,600. Now what I have done is I have recorded on 15th August the issuing or the sales part. So here we are going to issue it with the weighted average price. To get the weighted average price, we have to take the value 10,600 and we have to divide it with the total units, that is 1,800. So you will get $5.89 with 2 decimal places. So the value is 5,890. So we are left with 800 units as balance on 15th. So to get the balance value, what we are going to do, from 10,600 we are going to deduct the inventory issue cost of 5,890. So ultimately you will get the balance of 4,710. Now then on 20th August we are going to purchase another 1,000 at $6.50. So the value is 6,500. So we are going to add that the beginning of 800 at the same time this 1000. Therefore, the total unit cost is here 1800. Now we have to add the beginning inventory value with the purchase cost. So you will get 11,210 as the balance on 20th August. So on 27th August, what has happened? They have sold another 600. So we have to take the weighted average price to issue. That is 11,210 divided by 1,800. So the value is $6.23. So the total value here of the issue cost is 3,738. So when we deduct that 3,738 from 11,210, we are getting this balance of 7,472. And the remaining inventory value in unit is 1,200. Now let's see the summary of FIFO, LIFO and weighted average cost of inventory valuation methods. So here you can see the cost of sales figure, closing stock as well as the gross profit under each method. So you can see the highest cost of sale is recorded under LIFO when there is an increase in price. Why? We are going to issue at the latest prices, that is really high compared to the previous one. Then the closing stock figure is highest in the FIFO method. Why? Since we are going to issue the stocks with the old inventory, the remaining months are with the current prices, which is compared to high with the old prices in the case of inflationary scenario. And you can see the in-between figure in the weighted average cost. So what will happen to the profit? In the profit, since with the lowest cost of sales and highest closing stock, we are recording the highest profit under FIFO method and the lowest profit under LIFO method. So you can see when the closing stock rises, the profit also rises. When the closing stock decreases, the profit also decreases. So you have to identify these relationships when you are going to analyze the inventory of a company under these three methods. This is the end of chapter 3. So in this chapter, we have covered the cost of materials since it plays a significant role in the manufacturing organization and it represents 85% of the manufacturing cost. It's important to manage the inventory. So now you know what are the methods of calculating inventory and what are the levels of inventories. Later in the video, you have learned how you are going to value the materials or the stocks based on FIFO, LIFO and weighted average methods. You can use this for analyze the organizational liquidity performance. But for that, you have to identify what are the advantages and disadvantages of each method and the suitability according to your situation. Stay tuned and go through the rest of the chapters to gain more understanding with regarding to the management accounting. So keep watching more with regard into the cost and management accounting under these videos. At the same time, subscribe and share among your friends so they can have more knowledge and upgrade their knowledge with regard into the cost and management accounting.